All right, welcome to The Explainer. Today, we're going to dive into two totally different worlds that somehow exist in the exact same place. The Indian stock market.
In this world, you're thinking about years of growth, the real economic fundamentals, and that incredible power of compounding. This is all about long-term strategy, where you're making decisions for a horizon of, say, 5 years, or even more.
And then there's the other world, a world that sees the next 5 minutes. It's all about price action and hunting for that split-second edge. This is the world of immediate tactics, where, and get this, your entire day's work could be done in just a single minute.
So they're operating in the same market, but they're speaking completely different languages. So the real question is, which world makes sense for you? All right, let's dive in and really unpack these two mindsets. First up, let's grab the investor's telescope. We're going to zoom out and focus on the big picture, the long road ahead.
So what is long-term investing? Well, it's a strategy that's all about accumulating wealth over time. We're talking 5+ years. The core idea here is to let your wealth grow nice and steady right through the ups and downs of economic cycles. It's really about patience and, being a part of India's larger growth story.
And this whole approach, it's built on 4 really solid pillars. You've got compounding, where your returns start making their own returns. You've got earnings growth from strong companies. You've got market cycles, which help smooth out that short-term craziness. And finally, a behavioral edge, which is just a fancy way of saying you're less likely to make emotional, reactive decisions. At the end of the day, it's about letting time do the heavy lifting for you, riding out the waves, and making choices based on logic, not fear.
Okay, now this is where it gets really interesting. Look at how investors think. It's not about just one stock. It's about these huge multi-year themes. They're looking at financial services because of rising credit growth. They're looking at tech because, well, that's a massive structural trend. And of course, consumer goods, healthcare. They're asking, where is the Indian economy actually going over the next decade? And more importantly, how can I get my portfolio in on that action? It's all about those massive structural shifts.
So what's the takeaway here? An investor's decision isn't just a gut feeling. It comes from a checklist, from deep, deep research. They're looking at company fundamentals, debt, revenue, profit. They're checking out the order book, the political environment, the whole economic trajectory. It's way more like being a business analyst than just staring at a screen all day.
Okay, time to switch gears completely. Let's put away the telescope and grab the trader's microscope. We're about to zoom way, way in. And the language, it just changes instantly. You hear things like, market gir gaya, the market has fallen. It's immediate, it's reactive. This isn't about some 10-year economic trend. Nope. This is about what is happening right now, in this exact second.
Or you'll hear someone say, morning setup pe aa sakta hai. It could hit the morning setup. See, traders are looking for these very specific, pre-planned patterns on a chart. And if that pattern hits, boom, that's the trigger for an instant buy or sell. They're not digging through a company's 5-year plan, they're analyzing the chart's 5-minute pattern.
And this one, this says it all. Done for the day in 1 minute. I mean, think about that. Your entire day's profit or loss can happen in just 60 seconds. The goal here isn't to own a piece of a great Indian company. The goal is to profit from a tiny, momentary flicker in its price.
So, instead of those big, broad themes we talked about, a trader's focus is on hyper-specific price levels. A single number, like 23,830. That's not just a random number. That's a key support level for the Nifty index. For a trader, the entire direction of the market for the day could pivot on a single number just like this one. And just look at their dashboard. A trader is constantly juggling this flood of real-time data. We're talking crude oil prices, what the Dow Jones is doing, the India VIX, which is basically a fear gauge for the market, what other Asian markets are up to, earnings results, the list goes on. It's this incredible skill of connecting dozens of seemingly random dots, all to try and predict what's going to happen in the next few moments.
All right, so we've seen the investor's world and the trader's world. They're so different. So how do these two approaches really stack up, side by side?
And here's the breakdown. For the investor, the time horizon is 5+ years. For the trader, minutes to hours. The investor is focused on business fundamentals and big economic themes. The trader, price action, and real-time data. The goal for one is wealth compounding over time. For the other, it's about quick, small profits. It really distills that core difference. One person is playing chess, thinking moves ahead, while the other is in a high-speed reaction game. They're in the same arena, but playing by completely different rule books.
So, what's your path? Understanding these two worlds, it's not really about deciding which one is right and which one is wrong.
They're just different strategies for different goals suited to totally different personalities. And that's the key takeaway here. Each of these paths requires a completely different psychological makeup. Investing, that demands patience and real conviction to hold on tight through years of uncertainty. Trading, on the other hand, demands intense discipline, insane emotional control, and the ability to make split-second decisions under huge pressure. And, importantly, be okay with being wrong a lot of the time.
So you have to ask yourself which mindset really aligns with your personality, your financial goals, and, critically, your tolerance for risk. Are you built for the marathon, or are you built for the sprint? Answering that question for yourself, well, that might just be the most important investment decision you ever make.